Okay, so you've probably heard the terms ESG and green finance popping up all over the place lately. They're talked about as one of the biggest shifts in investing in a generation, but what do they actually mean? Let's cut through all the noise and figure it out together. To give you a sense of just how big this is, get a load of this number. We're talking about over $40 trillion. That's trillion with a T. That's how much money is currently managed in funds that focus on these environmental, social, and governance factors. So yeah, this is not some niche little trend. It's a huge wave that is completely reshaping the global economy. And that really is the million-dollar, or I guess trillion-dollar question, isn't it? ESG is a term we see everywhere, from boardroom meetings to news headlines, but a lot of the time its actual meaning can feel a little fuzzy. So let's break down exactly what those three letters stand for. The easiest way to think about ESG is like a report card for a company, but it's a report card that goes way, way beyond just profits and losses. It's a framework for looking at a company's actual impact on the real world and, how viable it is for the long haul. So, at its heart, ESG is just a set of standards that helps us measure a company's performance in three super critical areas that aren't purely financial. It really boils down to how they treat the planet, how they treat people, and how the business itself is run. Let's break this down. It's actually pretty simple when you look at it like this. E is for environmental. Pretty straightforward, right? It's all about a company's impact on the planet. We're talking its carbon footprint or how much water it uses. Then you've got S for social. This is the people part. How does a company treat its employees, its customers, and the communities it operates in? And finally, G is for governance. Think of this as the nuts and bolts of how the company is managed. Is it transparent? Is the board diverse? Is it accountable to its shareholders? Simple as that. E, S, and G. So why has this report card all of a sudden become so incredibly important? Well, it turns out that doing good can actually be really good for business. Companies are finally realizing that having a strong ESG profile is directly tied to managing risk, building the reputation, and, at the end of the day, finding reward. And look, this isn't just about ethics or feeling good. A strong ESG strategy helps companies attract investment from that $40 trillion pile of cash we saw earlier. It helps them spot and manage huge long-term risks like climate change or supply chain problems. It builds a brand that customers actually trust, and it attracts the best employees, people who want to work for a company that shares their values. And this really lays out the consequences perfectly. On one side, a high ESG performer is seen as a safer, more stable investment. They build incredible loyalty with their customers and become a magnet for talented people. On the other side, a low performer is just constantly putting out fires, they're facing regulatory headaches, public backlash, and they're struggling to keep their best people from walking out the door. The difference is just night and day. Okay, so if ESG is the report card, how does it actually change anything? Well, that's where green finance comes in. You can think of it as the engine that powers this entire shift. It's the money that moves based on those ESG scores, and it channels all that capital toward businesses that are trying to build a more sustainable future. This quote really gets to the heart of it. This isn't just about investors trying to avoid the bad guys or the big polluters. Green finance is the proactive side of the whole thing. It's about using money as a tool to actively build a different kind of economy. It's about funding the innovators who are developing clean energy or sustainable agriculture or all the other technologies we need for a healthier planet. And if you had any doubt that this has serious momentum, well, this chart says it all. The growth in ESG-focused investing has been absolutely explosive. It's so clear that investors now see sustainability not as a compromise you have to make, but as a key sign of a company's future strength. What was once a tiny niche is now, without a doubt, mainstream. All right, so we've covered the what and the why. But where is all this headed? What's next? Where is this incredibly powerful trend actually taking us? We're seeing this really rapid evolution. I mean, what started out as a niche interest for just a few specialized investors has now become a standard expectation. But the final step, and this is the one we're moving into right now, is where ESG is no longer a separate report or some side project. It's actually being woven directly into the core business strategy of the world's most successful companies. And ultimately, what all this means for you is that ESG isn't just some abstract financial concept. It's already influencing the world all around you. It's shaping the products you see on the shelves, it's defining the culture at the companies where you might work, and it's playing a huge role in how we tackle the global challenges we all face. And that leaves us with a really fascinating final thought to chew on. As these principles get more and more embedded in how we measure risk and identify opportunity, are we going to even need a separate category for it? Or are we heading toward a future where considering a company's real world impact is just, well, the smart way to do finance? Something to think about.